Hey everybody, Mark and Jeff here with the Charleston Area Living Group. Hey, so yesterday, Jeff, we went and listened to some really smart people.
He was very smart.
Yeah, what was his name again?
I got it, Dr. Joseph von
Nexton.
Dr. Joseph, that just sounds like a smart name.
Yeah, like way above our levels.
Mark Klim doesn't sound so smart. Jeff Gregg, not so much. But this dude was smart.
Imagine if he had Dr. Jeff Todd Gregg.
Three first names. I was going to go and listen to a doctor with three first names.
So we got some really cool information on kind of what the market was last year, kind of how it's looking, and maybe some information on what to expect in the coming year. And kind of the synopsis I heard that what we want to see is a slow, steady growth, right? Mm-hmm. And that if we look at 2020 and 2021, those were just kind of blips in the radar.
Yeah.
And looking from 2019 to now, we're kind of back on track of that trend line.
Yeah.
So
multiple slides we're going to show you
that
show that that's the case. Kind of the whole theme was that this year is going to be a reset.
Yes.
That, he said the economy, the housing market was on, he used several analogies of it's on caffeine, it's on a sugar high, but it's unsustainable.
Yep.
And that it has to come back to some normalcy. And I think you'll see in a lot of these slides that you were seeing that now. So this first one we saw, and I apologize, but we were in a big giant room and we were just taking pictures of the wall.
Just to remember
some of these things. So this is the South Carolina employment as a percentage of pre-recession peak. So the real short of this is, if you look, you'll see that the Great Depression, which is the red line, versus the COVID-19 recession, it just wanted to show that it's not even close to, it took 5, 6, 7 years, whatever it was, for that red line to come back to its immediate, to where it started. And with the COVID-19 recession, we're already back to the point of where it was when it started.
And I think that's the Great Recession from like 2008. Not great.
Oh, damn. Yeah. See, you were paying attention.
I was.
Yeah. One letter difference. Stuff. Recession, depression.
Well, same thing.
Yeah,
whatever.
Close enough.
Yeah.
All right. So next one. This one was interesting. Yeah. So Charleston is a big rental market, and the rental prices there, if you look at the blue line there in July of 21, really up.
Yeah.
And they're starting to come back to some normalcy. You'll see about just shy of a 5% increase is kind of what the average is year over
slow,
year.
Steady growth that we were talking about. Yep.
And so it looks like it's going to get back to that point where it was.
Yep. Employment growth, there's only one red on the
and that's construction.
Construction, which is kind of bad for new construction. But I think we're at that point now where they started so much construction that maybe they'll be able to rebound from that, get those people hired. Since we got this little bit of a inventory within new construction. It's almost, I think, over a third of our inventory right now. It was 700 homes.
Yeah, we're selling a lot of them.
Yeah, which is great. But if you look, every other industry has come back above pre-pandemic employment levels.
And we're going to see other slides in this deck that show that South Carolina has a very strong labor market. And we heard this doctor yesterday say 5 times that the overall economy and the housing market and everything else is all predicated on labor.
Yep.
On there being jobs.
So I'm going to show that one now. So here's the unemployment rate comparisons. Where full employment, or what the experts say full employment would be, where if anybody that wanted a job needed to work, they're saying unemployment should be at 5%. Our current South Carolina rate is 3.3%. So we have more people working than any other time in history right now.
Yep. He said there's more people. This was the lowest rate in South Carolina that there has ever been.
Right. And then we kind of went on and talked a little bit about the MLS sales.
Yeah.
And again, you see that trend line, and then you see the blip in the radar, right? But then as you see right now, it came back down to the trend line.
Yeah, everything he was saying said he really feels like, if we've had this trajectory of this over the years, and there's multiple graphs that then just show this big jump during COVID and then back down, but they're all back down to just about where they started. And he didn't feel like that they were going to go below that line.
No.
And we'll talk a little bit more about that if there is a recession coming in 2023.
Yep. And here's another slide to kind of point that out, where MLS sales, between the total sales volume, if you look at 2019 and compare it to 2022, it still increased 6.7%. But that's taking out 2020 and 2021 because those are like the anomalies, right?
Yeah, if you look from 16, 17, 18, 19, all in the 14,000 range of homes sold. Now, 15,000 in 2022, but then in 2021, that was when we had, 14 offers on every house, and houses were going for $30,000 more than list price. But yet again, it's a reset back to where it probably should be.
Right, on that trend line upward.
Yep.
So nothing to be scared about, basically, what we're trying to say.
No.
Here's another one just talking about single-family homes across the U.S. In that trend line up, and you see that blip in the radar and then back down. Days on market. You want to
Yeah. So we're used to seeing the average. What it probably should be for a balanced market is 4, 5, 6 months.
Right.
And we've seen if you see that line there that's drawn across, so
all the way from 2014.
It's a pretty steady amount of time there at 50, 60 days on market, and then we had this drop during the pandemic because what they said was everybody stopped spending money on travel, on and it was goods. Goods drove the market. Goods is what people buy, and that includes houses.
Yep.
So we saw this massive increase in the purchase and demand for houses, and so that
went way down.
Absolutely. And so this line here dropping down as low as it did, it just makes sense because we were selling houses in sometimes 2 days with multiple offers.
Yeah.
But you'll see that line is now coming back up, getting closer to. We're still a little short on houses, but nowhere near where we were, say, 12 months ago.
Right. So this slide we talked about list price minus sold price, and as you can see, that number dropped below zero in parts of 2021. That's because people were paying more for homes than the list price. But normally, there's some sort of gap between $5,000 and $10,000. And most recently, in the end of second quarter there of last year, you can see where that kind of came back up to that gap line.
Yep. So pre-pandemic, you had an average of, let's say, if a home was for sale for $400,000, the seller would give, $8,000, $10,000 sometimes in concessions. So it was the list price ended up being less, either through concessions or a drop in the price itself than the list price. So you see where those blue lines are below that straight line. This means that the homes were selling for more than list price, and we absolutely saw that in the market. But the good news is that line is getting back to some more of a normalcy. All these graphs, they go like this and then like this, or this and then like this.
Right.
And there's just that short window of COVID times, and every graph seems to tell the same story.
And we kind of see that in the mortgage industry too, right? But it was a little bit earlier where those 2% and 3% interest rates were just a blip in time.
Yep.
It might have been 2019, 2021, and then you see those interest rates come back to normal that we're seeing now, that 6 and 7%.
6.5 right now, and that is where it probably should be, where I think we'll see it in that 6 range. Listen, if we knew this, we'd be
millionaires.
We'd be the guy standing up there in front of the crowd. But I think we'll see some more normalcy in it, and it'll stay in that 6% range, which is probably yet again where it should be.
Yep. We continue to see South Carolina employment go up.
Yes, solid state.
Yep. And then median sales prices. This is just another one saying that basically it's coming back to that pre-pandemic levels. And actually, the 4.6% growth rate that we saw over time, you can see that continuing and that line coming back down, just like you were talking about with the blips.
Long-term number in Charleston has been a 4.6%. So, if your house costs $100,000 this year, it costs $104,000 next year.
$600, yeah.
So that 4% is a good, sustainable rate in Charleston. And if you look at, and we look at this with the rental industry here in Charleston also, is if you can make X percent on your house that you purchase as a rental every year, and then also gain 4.6% in more value on that property over the course, it turns it into a great investment.
Yep, great point. So we'll show a little snippet from Dr. Joseph von Nessen.
You got it.
I had to cheat too. Right at the end of this to kind of give you a good summary, less than a minute summary. But the bottom line, as you see on this slide, the South Carolina and U.S. economies have rebounded from that pandemic. Housing markets are readjusting, as we're seeing. They're coming off that Red Bull caffeine high. And then, there's might be further pullback in housing demand if the labor weakens, but Dr.
He was very pro, and especially he did say, listen, there's a difference between the U.S. market and the Charleston market.
Oh, yeah.
He said several times, if we do see a recession in the U.S. here this year, it's not going to be, he doesn't believe it's going to be anything extreme, and it'll be even less severe here in the Charleston market because we are so driven by the jobs that we have, the low unemployment rate, and just a solid economy here in the state.
People moving here, wanting to move
Absolutely,
here,
and more jobs moving here with them.
Yep.
So overall, I walked away with a good feeling about the Charleston market, and that we all knew that we needed this reset. It's here, it's happening, it's been happening, and I think we're looking forward to a good year.
And that's a good thing, right? I mean,
absolutely.
Yeah.
It was unsustainable.
Yeah.
That was the word that was used. It's unsustainable to keep going the way that it was.
So if you have any questions on this, let us know. Watch this little snippet here, and you can reach out to us at our phone number 843-732-9977 or on the web at
charlestonarealiving.com.
See ya.
The next 20 years happening in the southeastern United States. More people will be moving here to the southeast than any other region of the country between now and 2040. So what does that mean? As we heard earlier, people coming into the region, they're going to need houses. So that's going to continue to bolster demand, and it means we're going to see more and more demand in South Carolina going forward. And we are also looking to see more development in industry growth, manufacturing being one, and logistics being the other. Because when we think about more people moving to the southeast, including to South Carolina, that puts us in a very strong position for companies that want to locate here to be able to distribute goods throughout the southeast. And it also bodes well for advanced manufacturing as we move forward as well, which has been driving much of our growth over the previous decade. So a lot of reasons to be very bullish about the long run outlook for South Carolina, particularly for the housing market and the housing market in Charleston. So even though we are going through an adjustment period right now, I think the long run outlook for Charleston and for South Carolina continues to be very bright.